Welcome to CatEye U.S. stock. We watch markets with calm focus and sharp instincts. On Thursday, January 22nd, U.S. markets looked, honestly, very different from the start of the week. The Nasdaq climbed close to 1%, the Dow added roughly 300 points, and the S&P 500 pushed modestly higher again. Traders kept peeling back that so-called Greenland tariff risk premium after President Trump stepped away from fresh levies and the tougher military rhetoric. So the vibe was pretty clear. Confidence was coming back into the tape, but only as long as policy stayed restrained and the macro numbers stayed friendly. From there, you could literally see the story right on the S&P Heatmap. Roughly 2/3 of the board was green, not a melt-up, just a steady risk-on tone. Big boxes like Microsoft, Alphabet, and especially Meta lit up. And NVIDIA, AMD, and the rest of the chip group added a wide AI band of green across the screen. Tesla and Amazon pulled consumer discretionary higher, while healthcare and Procter & Gamble chipped in with some selective strength. The red stood out because it was isolated, not systemic. GE deep in the red in industrials, Netflix in communication services, and softer pockets in utilities, REITs, and a few regional banks. That heat map ties directly into where the money actually moved. Capital kept rotating out of classic safety and bond proxy trades and back into growth, AI, and domestic cyclicals. Technology and communication services led the tape, with Meta, Microsoft, NVIDIA, and Alphabet acting as clean expressions of that AI and automation theme. High beta discretionary, led by Tesla and Amazon, caught a strong bid, while energy and materials joined in alongside the small cap complex. On the other side, utilities, REITs, and many big box staples stayed under pressure, effectively funding this move back into higher beta leadership as the Russell 2000 notched yet another record close. Building on that rotation, the bigger picture was a market breathing easier, but not letting its guard down. Greenland-related tariff fears eased, GDP was revised higher, PCE stayed contained, and jobless claims held at historically low levels. Rates traded more orderly than earlier in the week, which points to a repricing of risk, not forced deleveraging. But the hedges stayed on. Gold pushed up into record territory, while crypto proxies like GBTC traded heavy, and Washington chatter around legal challenges touching Fed Governor Lisa Cook kept central bank independence in the conversation. Layer on the earnings reactions. GE and Netflix punished for muddier outlooks, while the AI leaders and P&G got rewarded. And you end up with a tape that's willing to add risk, but only where the forward story is clean and believable. Around that backdrop, the rumor mill and desk chatter filled in the edges. Traders kept pointing to the Russell 2000's winning streak versus the S&P as evidence of a so-called great rotation into domestic cyclicals. That's still a narrative, not a hard fact, but it's clearly influencing flows. Tesla remains a narrative magnet. Social channels and some research notes focused on Robotaxi expansion, NHTSA filings, and longer-dated autonomy plans. Those are forward-looking, speculative stories, but they still helped fuel a squeeze higher. And then there's Netflix. Options desks flagged unusually heavy call and put action clustering around one-year lows, as investors gamed its cautious guidance and deal uncertainty. That traffic is a sign of active positioning debates, not a final verdict on the company. Gold just hit a fresh all-time high, climbing to nearly $4,900 per ounce. What matters isn't just the level, it's the context. This move isn't happening during outright panic. Even after the recent tariff relief, investors are keeping their hedges on. That tells you something important. Markets are dialing down headline risk, but they're not dismissing geopolitical uncertainty at all. Gold isn't signaling collapse, it's signaling caution. This is about protection, not fear. Meta Platforms was one of the clearest winners on the board. The stock popped as investors leaned back into its AI and infrastructure roadmap, with fresh analysis pointing to upside versus those longer-term targets. On the heat map, Meta's bright green box helped anchor both the Nasdaq and the broader communications services sector. And that move mattered because it showed the markets still willing to pay up for large, cash-rich AI platforms when the macro fears stepped back. Tesla swung right back to the center of the risk-on story. Shares rallied as traders and online communities fixated on Robotaxi expansion, full self-driving timelines, and those longer-dated Optimus ambitions. Yes, that buzz is speculative and very forward-looking. But in this tape, it was enough to turn Tesla into a high-beta sentiment gauge again. The message here? Investors are willing to lean into upside autonomy scenarios, even with valuation and execution questions still very much alive heading into its late January earnings. Microsoft quietly did something important today. It showed up. The stock traded higher with the big tech complex, as easing tariff fears and solid macro numbers supported ongoing cloud and AI spending. And because Microsoft is the single largest weight in the S&P 500, its participation signaled that this rally was broad and credible, not just a squeeze in smaller speculative names. Investors are still watching margins into earnings, but for now, Microsoft's bid reinforces the core AI infrastructure story. NVIDIA didn't need fireworks to matter today. The stock moved higher with the semiconductor group, as investors rotated back into AI hardware champions, even with ongoing chatter about China-related roadblocks and rising memory costs. NVIDIA remains the central sentiment anchor for the AI supply chain. Its steady resilience in the face of very well-flagged risks tells you positioning is still net bullish, and that for now, pullbacks continue to attract buyers. On the flip side, GE Aerospace showed just how unforgiving this tape can be. The company delivered a strong recent quarter, but paired it with a softer forward revenue outlook, including a slower growth profile heading into 2026. Shares slid hard, standing out as a deep red outlier on the industrials heatmap and dragging on the broader aerospace and defense cohort. It's a textbook example of this regime. Guidance and runway matter more than today's print, when valuations already assume a lot of growth. Netflix was the big exception in an otherwise strong growth session. The stock stayed under pressure as the market kept digesting cautious 2026 guidance and uncertainty around a potential Warner Bros. Discovery tie-up. Options desks flagged unusually heavy call and put activity, as traders used Netflix for both downside hedges and speculative rebound bets. It's another case where the market's saying, if the forward story isn't crisp, even a big tech brand doesn't get the benefit of the doubt. After the closing bell, Intel delivered a bit of a reality check. The stock slid in after-hours trading on weaker guidance and cautious forecast commentary, even as names like NVIDIA and other AI-linked semis held up better. Desks framed it as one more data point in a growing split between perceived AI winners and laggards inside the chip space. It's also a clear reminder that, even in a friendlier macro tape, the AI story still has to clear the earnings bar, name by name. Procter & Gamble was a quiet but important counterpoint to the risk-on story. The stock jumped after delivering solid core EPS and a steady outlook, even as many other staples traded in the red. Investors rewarded P&G's execution and pricing power, highlighting that selling defensives doesn't mean abandoning them altogether. In this market, high-quality defensives that actually deliver on the numbers can still attract fresh money, even while capital rotates toward growth and cyclicals. Looking ahead, this relief rally now runs straight into a heavy calendar. Next week brings durable goods, consumer confidence, manufacturing surveys, and fresh inflation readings, all feeding into the same core question. Does the soft landing story still hold? The FOMC decision and press conference sit right at the center of that, especially with Washington's broader policy backdrop and the ongoing debates around Fed independence still hanging in the air. Layer on high-profile earnings from big tech and Tesla, and you've got a setup where leadership can change quickly. The market's leaning risk on again, but it's doing it with tight stops and a very short leash on guidance. So we close Thursday with a market that feels repaired, but not relaxed. The Greenland tariff scare's been downgraded to a volatility episode, not a full-blown growth shock, and money is flowing back into higher beta leaders and small caps. At the same time, record gold, weaker crypto, and selective selling in rate-sensitive pockets tell you the hedges are still firmly in place. From here, the story shifts to the Fed and to earnings guidance. Those two will decide whether this is the start of a more durable advance or just a very well-timed relief rally. Thank you for watching CatEye U.S. Stock. Stay curious, stay calm, and we'll see you next time.